I'm Paul Kaplan, Director of Research at Morningstar Canada. Today, I'm talking to Mark J. Kempstra, who is a professor of finance at York University's Schulich School of Business. Much of Professor Kempstra's research focuses on investor and market behavior through the lens of psychology. In particular, Professor Kempstra has studied how psychological factors lead to seasonality in investor behavior and market returns. Professor Kempstra, thank you for talking to me today.
Well, thanks for having me, Paul. It's a real pleasure.
Why do you think it is important for economists, especially financial economists, to incorporate elements of psychology into their analyses?
Well, I guess to start with, we're human, so we're affected deeply by our psychological biases and our kind of view of the world. So it's not all just rational individuals responding in probably the best way possible. It's us coming with our hundreds of thousands of years of evolutionary behavior, and all these things impact the way we behave.
Behavioral economics and finance, once a fringe area, has now garnered Nobel Prizes for two of its leading researchers, psychologist Daniel Kahneman and economist Richard Thaler. How has their work and the work of others in behavioral finance changed the way that financial economists view investors and markets?
I'm obliged to throw in Bob Shiller, another recent Nobel laureate. I think of him as his most important work as being behavioral, although I love all of his stuff on GDP bonds and other things. How is this work influencing the way financial economists and investors view markets? Well, I think that this has highlighted the issue that when we look at market movements, we can't just pretend they necessarily reflect best response to a given situation, that sometimes there's going to be behavioral effects like herding that can push prices around. Even if for short periods of time, this can be a problem. And when they lift prices away from where we think they should be for prolonged periods, like I would describe Bitcoins having the price of Bitcoin being pushed away from its fundamental value for a very long time, it misallocates resources, and this is a real problem for our society.
Now let's discuss your research on seasonality. First of all, please explain what you mean by seasonality, both in terms of investor behavior and market behavior.
The kind of seasonality that I focused on in my research with collaborators Lisa Kramer and Mo Levy, amongst others, is a seasonality which is throughout the year. You can't speak of seasonality being day of the week and other effects like that, but we've looked at really over the course of the year. Our first work was on daylight savings, looking at 2 days of the year in particular where there was a daylight savings time change, and then fall versus spring variation in mood, which impacts us. Seasonal affective disorder is something that impacts all of us probably to some degree, and some people to a much greater degree. And that kind of depression has been shown by psychologists to be associated with changes in serious changes in mood leading to changes in risk aversion. So if it changes risk aversion, it could change market prices.
What was your motivation for pursuing this line of research?
Well, honestly, it was serendipity that led to this research. I came at this work thinking about market prices mostly from the point of view of market efficiency. Noticing some deviations, but noticing how a lot of the deviation could be accounted for, at least in the long run, by common sense or at least cash flow considerations. And it was a day on the campus of UBC that two of my co-authors started talking about the daylight savings effects that psychologists had noticed, and shortly thereafter the three of us started working on quantifying the impact on financial markets. From there, we talked to psychologists because we're just fascinated by this. So we found that the biggest impact that on people in terms of psychology, the mass impact of seasonal affective disorder was larger than anything else. This is nice because it synchronizes all of us with our mood, essentially. So other effects, divorce, death in the family, is very idiosyncratic. It's terrible. It really affects an individual's mood, but it's unlikely to impact markets. But if 10 or 20% of us are all getting a little nervous about taking on extra risk, then this could dramatically impact markets. I come from Dutch farmers on my father's side, and the winters are long and hard in Holland. If you didn't get a little nervous in August and September and started putting away food for the winter, you might not make it. So I think this evolutionary route to a little bit of nervousness and anxiety and depression in the fall has been very helpful for us as a species, but it doesn't always help us as investors.
Please explain the research that you and your collaborators have done on seasonality and market returns.
The stuff we've looked at in market returns have focused on large market economies, although we did subsequent work that looked at a broader set of maybe 40 or 50 economies. We looked at far northern economies, southern hemisphere economies, the US, of course, and Canada. And what we've looked for was this broad overall pattern of asset prices being hit in the early fall by investors becoming more risk averse. And the way this works is first asset prices will fall or not rise as quickly when people become more averse to risk. And then if you hold through this period of anxiety, you get higher returns over the next coming period. So we anticipated and found these lower returns at the beginning of fall and higher returns as you held through to spring. Similar to the sell in May effect, I guess, but the timing's a little different, and the motivation is not an ad hoc kind of noticing there seem to be patterns in returns, but rather something motivated by something substantial like a change in risk aversion.
Please explain the research that you and your collaborators have done on seasonality in mutual fund flows.
When we started thinking about the effects in returns, of course, we thought about quantities too. So you've got flows from returns, you've got flow and quantity. And if people really are becoming more risk averse, what we should see is some kind of pressure in flows. The first thing we thought to look at was mutual fund flows, just because these represent mostly, broadly, 70 or 80% are held by individual investors as opposed to institutional investors. We imagine that institutional investors guided by groups of people and professionals would be less impacted by changes in risk aversion. They've got a portfolio strategy to follow, and they follow it. And it's also a little easier, maybe losing other people's money, not your own. I don't know. But good fund managers, from my perspective, hold to the strategy. But individual investors can deviate. So we looked at fund flows, which would reflect, in large part, the flows of individual investors. And we found in the fall, indeed, people were moving out of equities. Presumably hedge fund and other professional investors were picking up that flow. And then in the spring, they were moving back into equities. And the reverse happened with money market funds and other relatively safe asset classes for mutual funds. So it was just a logical progression from looking at returns. The obvious question was to consider quantity of flow.
Is there direct evidence that individual investors undergo seasonal changes in risk preferences?
That's a great question, too. We got asked that a lot by people when we first started this research strategy. Of course, it's hard to work on too many things at once. One of my co-authors, Lisa Kramer from the University of Toronto at the Rotman School, she, together with a colleague at the Rotman School who's a social psychologist, did a big survey of individuals. They gave them a incentive-compatible task. Basically, they could put their money in a safe asset or risky asset, and they got payoffs from it. So they had fairly good funding. I think they went and surveyed maybe 1,000 or more people, and they did this at 3 points, basically summer, winter, and then summer again. And they found remarkable variation in mood according to standard psych questions on mood and kind of that sort of lean. And then they also found strongly statistically significant variation in willingness to tolerate risk. So people were much more willing to tolerate risk in the summer than in the winter. And people who tended to be more affected by seasonal mood disorders, the effect was a larger effect, more substantial, but it was in everyone that looked at. So there is evidence from individual investors and actual, incentive-compatible choice. It's fascinating.
What lessons should individual investors learn from your research? Should they change their behavior?
That's also a great question. I guess what I'd advise individual investors to do is have an idea of a strategy that makes sense for them, that they're comfortable with, and maybe not look at their portfolio too often. Probably the most important thing that I pay attention to is when I see news and it makes me nervous and I see the markets reacting. I also look at the time of year. So I know in the fall and winter, people are going to tend to react more strongly to bad news and less strongly to good news. And so when I see the market really getting volatile in the fall, I remember that part of that activity volatility is probably coming from people reacting differently because of their mood being in a more depressed state. In the spring, if markets are reacting really strongly to news, I guess I sit up and I pay a little more attention because I think this is people who are not so disturbed by any kind of mood disorder, and therefore it's more informative watching what's going on in the market.
Is there anything you'd like to add?
Well, diversify. Try not to imagine you can time the market too much. I have played with timing the market myself occasionally with my wife, just looking to see if we can make trades on our daylight savings hypothesis, and even SAD. It's fun to play a little bit. I guess if you really want to play a little bit, put some money aside, but the bulk of your savings probably be a little more conservative and try to understand yourself.
Thank you, Professor Kempster, for taking the time today to discuss your research and its implication for investors.
It's a real pleasure, Paul. Thank you for having me. Great to see you.